risk management in the financial technology sector, and risk management in FinTech. Solomon Fadun, Risk Management of Everything Channel, presents risk management in the financial technology, FinTech, sector, and risk management in FinTech. Welcome to the Solomon Fadun, Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to notify you when we upload new videos. Thank you. This video discusses risk management in the financial technology, FinTech, sector, and risk management in FinTech. In this video, you will understand the meaning of risk management, the importance of risk management, financial technology, FinTech, examples of FinTech, the importance of FinTech, what FinTech does and how it works, FinTech company, types of FinTech and FinTech products, how FinTech facilitates economic development, why FinTech is crucial to risk management, reasons FinTech need risk management to survive in the global competitive market, risk associated with FinTechs and FinTech companies, risk management process in FinTech, FinTech Ecosystem, risk management responsibilities of FinTech companies, risk management challenges for FinTechs, and enhancing the risk and compliance capability of FinTech. Now, let us start. Risk management. Risk management encompasses identifying, analyzing, and responding to risk factors that form part of the life of a business. Risk management identifies, assesses, and controls threats to an organization's capital and earnings. Effective risk management helps prevent future outcomes by being proactive rather than reactive. Hence, risk management helps reduce the possibility of a loss and its consequences occurring in the future. Generally, risks emanate from several sources, including operations, regulations, contracts and subcontracts, natural disasters, strategic planning, cybersecurity, and partnership legal liabilities. Information technology, IT, security threats, data-related risks, and strategic risk management to minimize risk exposures and improve the firm's performance. Organizations are exposed to positive and negative risks that impact their operations and performance. Integrating risk management into a firm's strategic planning is beneficial, thereby improving business continuity and performance. Consequently, risk management enables organizations to be proactive by preparing for unexpected events to ensure speedy recovery and business continuity. Importance of risk management. Risk management helps organizations save costs by planning before unpleasant events occur. Risk management helps organizations in managing risks to minimize their impact should they occur and cope with the results. Understanding and controlling risk makes organizations more confident in their business decisions. Understanding and controlling risk makes organizations more confident in their business decisions. Furthermore, strong corporate governance principles ensure sound risk management to improve organizations' performance. Effective risk management ensures that risks of high priority are dealt with as aggressively as possible. A company's management needs the necessary information to make informed decisions and ensure the business remains profitable. Risk management is beneficial to individuals, companies and organizations. Risk management is vital to businesses as it helps in 1. Ensuring a safe and secure work environment for all staff and customers. 2. Improving the stability of business operations while also decreasing legal liability. 3. Protecting a business from events detrimental to the company and the environment. 4. Protecting a firm's assets, including human resources assets, from potential harm. And 5. Helps establish the organization's insurance needs to save on unnecessary premiums. Having explained risk management and the importance of risk management, let us discuss financial technology. What is financial technology, FinTech? FinTech is an acronym for financial technology. FinTech refers to apps, software, or technology that help individuals and businesses to digitally access, manage and gain insights to ensure sound financial transactions. Financial technology, FinTech, is a software or mobile application that makes it easier for businesses and consumers to perform financial transactions. FinTech, therefore, help improve conventional financial transactions using the latest technologies to reduce operational cost and improve service delivery. FinTech constitutes the emergence of a sector that uses technology to simplify conventional financial operations. FinTech helps a business to provide a wide range of financial services using software and modern technology. As consumers increasingly adopted digital tools, FinTech helped consumers address financial challenges and progress toward financial goals. FinTech consists of technologies related to finances, from banks to capital markets such as investment firms, hedge funds, and credit card companies. Financial technology, FinTech, refers to software, mobile applications and other technologies created to improve and automate traditional forms of finance for businesses and customers. The FinTech industry encompasses everything from payment systems and banking tools to online marketplaces for loans and insurance, even software used by the financial sector. FinTech includes everything from straightforward mobile payment apps to complex blockchain networks that house encrypted transactions. FinTech is a multifaceted concept. It simplifies financial transactions for consumers and businesses, making them more accessible and affordable. FinTech also applies to companies and services utilizing AI, artificial intelligence, big data, and encrypted blockchain technology to ensure secure transactions. The FinTech sector has grown significantly. FinTech is a fast-growing industry that helps companies explore avenues like productivity enhancement, cost reduction, innovation, and risk management. FinTech helps streamline transaction processes to protect data and systems from vulnerabilities. Modern FinTechs are driven by artificial intelligence, AI, big data and blockchain technology, which have redefined how companies transfer, store and protect digital currency. Having understood the meaning of FinTech, let us consider examples of FinTechs. Examples of FinTech. Here are examples of FinTechs. 1. Online and mobile payment systems. FinTech companies have changed how buying and selling products and services are done globally. Money transfer with the help of smart devices was a myth years back, but it has become a reality today through FinTechs. Hence, FinTechs have improved online shopping and mobile payment systems to reduce physical cash transactions. 2. Trading. FinTechs have made investments and trading more easily. FinTechs promote economic activities because trading helps to foster remote trading to expand money with time. Trading is one of the safest ways to make money quickly, which is possible through FinTechs. Trading is done through foreign exchange transactions, stocks and bonds. Several online platforms have been developed specifically for trading. Online trading is increasingly becoming more popular daily. Today, trading can be done through computer-based platforms, mobile phones, and other electronic devices. FinTech, therefore, helps promote trading as several stock trading apps ensure easy trading. 3. Cryptocurrency and blockchain. The list of examples for FinTech is incomplete without mentioning cryptocurrency and blockchain. Buying or selling bitcoins has helped reduce fraud or flawed transactions and protect financial data on blockchain technology. FinTechs facilitate transactions via cryptocurrency and blockchain. The importance of FinTech. Technological advancement has helped businesses to improve their operations. FinTech enables firms to be innovative and improve their operations. And one of them includes FinTech solutions. FinTech solution is a process through which banking, insurance, or other financial services innovations have led to new technologies that have made possible cheaper, faster, and more effective customer transactions. It is a revolution that changes how things work by providing new services and products. FinTech is an essential pillar of the financial system. FinTech has, therefore, transformed financial services with the help of financial software developed by FinTech software developers. Here are some of the importance of FinTech. 1. The fintech revolution helps in building a better economy. The evolution of fintech has been evolving and changing the financial sector in the best possible ways. Not to overlook that several industries in the financial sector are transferring to digital processes from manual processes with the help of financial planning software. Furthermore, with technological advancements, fintech has facilitated the fast-paced acceptance of paperless lending, mobile banking, digital payment, and e-wallets. Since fintech is easy to use and can be used by anyone, it is now available to people who have never used such financial services. 2. Fintech is a cost-effective alternative. When comparing fintech and traditional banking, fintech companies provide top-notch services at a minimal price because there are no physical branches. Some banks also help customers keep more cash in their wallets by waiving the fee for opening a bank account. Fintech also helps businesses automate numerous operations using fintechs to reduce operational costs. Moreover, some fintech apps are making the traditional bank obsolete since an individual can easily do many functions from a smartphone. 3. Fintech ensures transparency and compliance. The advent of digital and mobile services has improved transparency and accuracy. Fintech platforms help reduce operational risk and fraud in the financial service sector. It also helps achieve faster growth for financial institutions and other businesses by delivering new customer services. Furthermore, fintech is crucial in ensuring financial institutions comply with regulatory requirements, including Know Your Customer, KYC, and anti-money laundering, AML. The transparency and compliance aspect of fintech is vital for the financial sector. 4. Fintech enhances business. The fintech industry promotes business growth and improves performance. Most importantly, it helps manage resources efficiently and effectively to ensure accountability. Fintech benefits banks and other financial institutions as it helps improve operational efficiency across several industries. 5. Fintech is shaping today's financial industry. Banks dominated the financial sector in the past, but today's banking scenario has changed. Financial institutions are now witnessing several challenges, including cyber attacks, reduced productivity and loss of profits. FinTech assists businesses in improving operations infrastructure and information technology, IT, systems. FinTech also helps ensure digital banking. Digital banking has significantly revolutionized banking software services to ensure efficiency and reduce operational costs. Hence, FinTech is a significant driver of the growth of digital banking. Traditional banking was designed as an offline system where transactions occur in physical locations, for example, through bank branches. In contrast, digitalization reduces the need for physical bank transactions. The fintech industry is vital in enhancing digitalization in the banking sector. Fintech services firms contribute significantly to markets with innovative business models and products. For example, leading fintech firms, including N26 and Monzo, provide financial services through a smartphone app. They have grown beyond today's banking model by using technology to provide improved financial services at an accessible price with faster delivery times. These companies use new technologies like blockchain to ensure an outstanding customer experience. What fintech does and how IT works. There are several types of fintech apps which work in different ways. Some fintech apps safely unlock financial account data, for example, transactions and account balances, with another app. At the same time, some enable users to track their investments across multiple platforms. For example, wealth and financial management apps will aggregate financial account data from different accounts into one easy-to-read snapshot, showing users their financial information in one convenient place. The fintech apps might also suggest ways for users to improve their financial position based on the available data. Another fintech category is apps that allow users to do things like trade stocks or cryptocurrencies. Robinhood and Coinbase are good fintech examples that enable users to quickly and easily make various investments. Several types of tools are necessary to make FinTech apps work. Here are some of the tools that make FinTech apps work. 1. APIs. APIs mean Application Program Interfaces. Financial APIs help FinTech apps work effectively. Financial Application Program Interfaces, APIs, safely and securely connect consumers' bank accounts to FinTech apps and services to share financial data, transfer funds, and verify their identities. 2. Mobile applications. Most FinTech companies offer a mobile app to users to access their funds and insights anytime. Generally, a digital banking app, financial management tool, investment platform, and mobile apps are synonymous with FinTech. 3. Web-based solutions. Besides offering a mobile app, some FinTechs also provide a web-based solution where users can log in via a web browser and perform the same function as mobile apps. FinTech has changed the mode of business activity with the power of APIs to safely unlock financial data and convenient mobile apps. For example, it is increasingly likely that friends and family who want to send money to each other would use Cash App or PayPal rather than exchange cash or checks in person or via the mail. What is a FinTech company? A FinTech company offers financial services and applications that rely significantly on technology. FinTech companies are industry boasters that use technology to change how consumers interact with the financial industry. FinTech companies' operations include improved access to financial products, reduced operational costs, and ensured faster and personalized services. FinTech is often used as a self-identifier rather than a specific label from an organization that oversees the industry. The best-known examples of FinTech companies are FinTech banks. Let us discuss the types of FinTech and FinTech products. Types of FinTech and FinTech products. FinTech is used widely in business organizations, including business-to-business, B2B, business-to-consumer, B2C, and peer-to-peer, peer-to-peer, markets. Here are some examples of the types of FinTech companies and products in the financial services industry. 1. FinTech banks. The banking services, which is the financial system's core component, have been shaken up by FinTech. FinTech has simplified banking services, including account opening, funding and reduction of fraudulent sign-ups, to ensure quick and easy operations via technology like Plaid Auth and identity verification. Likewise, neobanks like Varo offer flexible personal checking accounts, high-yield saving accounts, and secured credit cards without the traditional fees that hinder people from achieving their financial goals. 2. Digital payments. Cashless payments are increasingly used globally. The global pandemic also increased cashless payments and digital transactions significantly. Hence, payment apps are now common because receiving payments via direct bank transfer is faster and less expensive than using credit cards and getting users signed up and authenticating transactions. In the United States, Plaid allows consumers to instantly connect their bank account to an app or service for digital payments. For example, the Shift app aims to simplify buying a used car via the ACH network. On the B2B side, apps like Wave help businesses pay bills, do bookkeeping and send payroll digitally through the ACH network. 3. Personal financial management. Personal financial management, PFM, apps help users consolidate financial information from several accounts into a single dashboard, making it easier to manage their finances. These services help people to manage budgets and make sense of their money. Examples include Dave and Bridget. Another leading personal financial management, PFM, app, Copilot, helps its users build an accurate picture of their financial health and net worth. 4. Wealth management. FinTech solutions help financial advisors and wealth management platforms aggregate held-away account information to grow assets under management better while delivering more holistic financial advice. For example, some finance firms, for example, Atom Finance, offer products and features to help users research and track their investments in one place. Likewise, The Stash is a subscription platform that gives customers easy and affordable access to investment, education, and financial advice products. 5. FinTech lenders. Fintechs facilitate lending services frequently referred to as peer-to-peer lending, person-to-person lending, peer-to-peer lending, and peer-to-business or person-to-business lending, P2B lending. Fintech lending works through a digital platform that matches lenders with potential borrowers, enables lenders to gain more attractive returns than savings accounts or other investments, and reduces borrowers' interest rates to traditional financial institutions. Fintech helps lenders assess applicants by processing the collected income information, account balances, and asset records. Fintech also enables borrowers to connect their bank accounts to receive and repay loans, which can be cumbersome. Top Fintech lenders, including SoFi, Prosper, and Solo, use technology to overcome lending challenges and provide more consumer-friendly loan choices. Fintech lenders help consumers avoid predatory loans and give them access to new loan types, including peer-to-peer loans. Likewise, Plaid offers products and services that enable users to link financial accounts. Plaid helps by streamlining the loan process for borrowers while giving lenders access to the user permission bank, payroll, and other data they need to make informed lending decisions. Consequently, Plaid uses fintech to ensure faster and easier for customers to identity verification, authenticate accounts, check balances in real time, and verify their financial obligations. 6. Embedded finance. Embedded finance integrates financial services, including lending, payment processing and insurance, into non-financial businesses' infrastructures without redirecting to traditional financial institutions. Embedded finance consists of financial services offered to consumers through non-financial products and services. For example, Shopify Balance provides business checking accounts for Shopify users to help them get paid faster and efficiently manage their business. Shopify is not a financial institution, making Shopify Balance a financial product embedded in a non-financial product. Likewise, companies like Unit and Checkout are helping make this ubiquitous through API integrations that embed financial services directly into non-financial companies' products or user experience. Embedded finance use has grown significantly in recent years and is expected to increase substantially. 7. Blockchain technology and artificial intelligence. The financial technology, FinTech, industry continues to invest in innovations to create new products and support evolving customer preferences. Emerging technologies such as artificial intelligence, AI, robotics, and machine learning are increasingly the core elements of FinTech's product portfolios and customer interactions. Therefore, FinTech supports blockchain technology and artificial intelligence, AI, by utilizing technology to provide trading, exchange, and new generation financial services to improve business activities. How FinTech promotes economic development. The FinTech ecosystem is a growing entity that promotes economic activities. The FinTech framework helps in boosting economic development and increases job opportunities. Research has shown that FinTech has contributed significantly to innovation and financial inclusion regarding numbers and financial software development. It has helped boost income for millions of people, particularly in emerging markets that live in poverty. FinTech also contributes to economic growth by facilitating new digital technologies and methodologies. It has facilitated ease of transaction and digital data collection, increasing employment opportunities. This field covers a variety of activities, including the transfer of assets, payments, and investments through the Internet. The FinTech ecosystem works as a bridge between providers and consumers. It, therefore, provides a platform for innovation in the financial sector. It has helped to enhance financial inclusion by bridging the gap between technology and business models related to financial services. Why FinTech is crucial to risk management. FinTech is an emerging field that focuses on developing financial services using technology. FinTech risk management aims to manage the potential risk exposure due to innovations, collaborations, and unexpected market development that may arise from their business operations and regulatory authorities. FinTech is crucial in risk management for the following reasons. 1. FinTech helps track activities, allowing a business to respond in real time. 2. FinTech ensures data-driven predictions to aid decision-making. 3. FinTech facilitates the understanding of business impact and customer response. And 4. FinTech helps monitor financial and operational performance. Meanwhile, FinTech companies and the FinTech sector also need effective risk management to survive in the global competitive market. Reasons FinTech needs risk management to survive in the global competitive market. The global pandemic has accelerated the growth of the FinTech market as consumers consider alternatives to services they would have accessed before the pandemic. FinTechs are technological driven. Hence, FinTechs are susceptible to diverse risks. These fast-growing companies must manage risk effectively to last the course and withstand the pressure of more well-established competition. Here are some ways FinTech companies can effectively manage their risks. 1. Cyber attacks. The FinTech sector is a significant target for cybercriminals looking to exploit vulnerabilities inherent in services such as mobile payment. FinTech companies need to establish robust network and consumer data security processes to mitigate the risk of breaches. 2. Technology failure. Technology failures and resulting service breakdowns are a considerable risk for FinTech. Hence, there is a need for FinTech companies to be more strategic and systematic in strengthening their operational resilience. 3. Professional liability. With many new financial products and distribution methods, FinTech companies are vulnerable to risks associated with customer service and delivery mistakes. Investment in research and training helps in reducing professional liability for FinTech companies. 4. Increased attention from regulators. As FinTech companies bring innovative technology and service delivery to the marketplace, regulators will be on the tails of any signs of negligence. FinTech must keep up with regulatory obligations and updates with a suitable risk management system. 5. Establishing and keeping consumer trust. Consumers expect a smooth and safe experience when their funds are handled digitally. Consequently, FinTech needs risk management to survive in the global competitive market to establish and foster consumer trust. It is beneficial to discuss risks associated with FinTechs and FinTech firms. Risks associated with FinTechs and FinTech companies. FinTech companies are exposed to new and emerging risks due to the dynamics of technological advancement. FinTech firms must adapt to more robust risk measurements that match such speed and space. Risks associated with FinTechs and FinTech companies include fraud risk, merchant risk, regulatory risk, anti-money laundering and countering terrorist financing, consumer risks, cybersecurity and data privacy risk, credit risk, operational risk, outsourcing risk, partnership risk, and business continuity risk. Having highlighted risks associated with FinTechs and FinTech companies, let us discuss the risk management process in FinTech. Risk management process in FinTech. There are 5 basic steps in managing risks. These steps are known as the risk management process. The risk management process is a framework for the actions that should be taken. A risk management process entails identifying, analyzing, prioritizing, treating, and monitoring potential risks. However, it is necessary to emphasize that it is essential to understand the circumstances in a firm's risk management process. This is necessary to understand the context of the risk management process to establish the criteria used to evaluate the risk and define the structure of the required analysis. Here are the 5 steps of a risk management process in FinTech. Stage 1, Risk Identification. FinTech is susceptible to diverse risks, including fraud, operational, consumer, merchant, outsourcing, and anti-money laundering risks. Hence, identifying specific risks related to FinTech operations is necessary. Risk identification is crucial to analyzing a firm's FinTech risk. It helps in determining the nature, source and impact of the risk. Risk identification helps to identify FinTech risks for security and compliance governance. The risk identification stage helps a FinTech company to identify and define potential risks that may negatively influence a specific company process or project. The organization should uncover, recognize, and describe risks affecting the firm's project or its outcomes. Several techniques can be used in identifying organizational and project risks. The identified risks can be used to update the company's risk register. Stage 2, Risk Analysis. After identifying potential risks, the next thing is to determine the likelihood and consequence of each risk. This is necessary to understand the nature of the risk and its impacts on the company's operations. The risk analysis results should be used to update the company's risk register. Based on the risk appetite statement, the FinTech firm must develop risk indicators and scales to guide the firm's operation. The company must analyze risks associated with its business operations. In doing this, the committee must establish a robust method for identifying critical business processes, recognizing operational weaknesses and regulatory requirements. Step 3, Evaluate and rank the risk. The company must decide whether the risk is acceptable or severe enough to warrant treatment. It is necessary to assess and rank the risks using the company's risk ranking methodology and framework. It would be best to evaluate and rank the risk by determining its magnitude, which is the combination of likelihood and consequence. The risk is then further assessed after determining its overall probability of occurrence and its effects. The company can then decide whether the risk is acceptable and whether it is willing to take it based on its risk appetite. This is necessary in determining the risk indicators to guide risk-taking for FinTech operations within the overall risk appetite statements. The company's risk register must be updated using the risk rankings information. Step 4, Risk Treatment. Risk treatment is also known as risk response planning. The risk treatment entails selecting and implementing risk treatment options. At this step, the company will assess its highest ranked risks and develop a plan to alleviate them using specific risk controls. How could the company minimize the probability of harmful risks and maximize opportunities? To address this situation, the company must create risk mitigation strategies, preventive plans, and contingency plans to treat the company's risk exposures. The company must also include the risk treatment measures for the highest ranking and most severe risks in the risk register. Step 5, Risk Monitoring and Review. This is where the company will use the risk register to monitor, track and review risks. The company's risk and compliance team must be active at this stage. The risk and compliance team is accountable for providing a biannual strategic overview of corporate risks to the committee and board. The overall risk management process should be monitored and updated regularly. The company must set a threshold, tolerance level, and key risk indicators, KRIs, to ensure good monitoring and review. Key shareholders must be included in communication and consultation at each risk management stage to ensure a good monitoring and review process. Financial Technology Ecosystem. The FinTech revolution has revolutionized business operations because mobile payments change consumer spending habits. Online brokerage services create opportunities to make investments from home, financial chatbots advise individuals about new products and services, online banking is part of day-to-day lives, and cryptocurrencies are essential to asset portfolios. FinTech helps combine banking expertise with modern management science techniques and the computer. Hence, FinTech is a new financial industry that applies technology to improve financial services activity. FinTech is now the core of financial innovation, producing great value for clients and investors to generate valuable risk scenarios. It is, therefore, necessary to highlight the 5 elements of the fintech industry. The fintech industry's ecosystem consists of 5 elements. 1. Fintech startups. This includes wealth management, payment, capital market, crowdfunding, lending and insurance enterprises. 2. Technology developers. This includes cryptocurrency, cloud computing, big data analytics and media developers. 3. Financial customers, including individuals and corporate clients. 4. Traditional financial institutions include conventional banks, insurance enterprises, stock brokerage firms, and venture capitalists. And 5. Government. This consists of financial regulators and legislatures. Risk management responsibilities of fintech companies. While effective risk management requires close coordination between fintech and the bank, there are specific risk management responsibilities of fintech. Fintech provides the infrastructure and technology necessary for fintechs to deliver financial products to customers securely. Fintech also support banks and other financial institutions in managing risks and compliance commitments. While effective risk management for fintechs requires close coordination between them and their sponsors, including banks and other financial institutions, fintechs have some risk management responsibilities. Let us discuss 6 core risk management responsibilities of fintechs. 1. Manage risk across all aspects of the sponsor's business. Fintech needs to understand, track, and mitigate risk in core aspects of the sponsor's business. Fintech needs to manage risk in the following 3 elements of banks and financial institutions' operations: 1. Regulatory and compliance risk, 2. Application and data security risk, and 3. Operational risk. It is necessary to explain these 3 categories of fintech risk management. Regulatory and compliance risk. To facilitate sound regulatory and compliance risk management, fintech needs to focus on fulfilling the requirements within established areas of oversight core activities, including anti-money laundering, AML, Know Your Customer, KYC, Know Your Business, KYB, and Office of Foreign Assets Control, OFAC. Application and data security risk. The fintech with application and data security risk includes software development lifecycle, SDLC, data management, information technology, information security, access controls, data handling, patch and security management, vulnerability management, and penetration testing. Operational risk. Fintech must help banks and other financial institutions manage operational risks, including human resources, employee training, third-party outsourcing, vendor management, and other risks associated with people and processes. The risk landscape is further complicated based on the specific industry in which fintech participants. 2. Business continuity planning. A business outage can catch organizations off guard, with detrimental results. Research has shown that 40% of businesses do not reopen after a disaster, and 25% fail within 1 year. Business disruption can be minimized through adequate planning. A business continuity plan will help fintechs to prepare for such events. Sponsor firms, financial institutions and regulatory bodies must embrace business continuity planning, focusing on continued business operations, documenting business continuity plans, and risk assessment programs. Business impact analysis, BIA, and risk assessment can help businesses prepare for, respond to, and mitigate emergencies. Business impact analysis, BIA, and risk assessment can be done internally or outsourced to professionals. I recommend performing a BIA and risk assessment internally versus outsourcing these activities. This evaluation reflects the internal risk of an organization, which internal resources would know best. By developing a BIA and risk assessment program internally, business continuity, information technology, and information security teams can conduct deep dives into their programs, identifying gaps and addressing how to bridge them. These internal resources can speak intelligently to fintech's risk management processes, precisely what the regulators want. 3. Business resiliency in the face of outages and failures. Business interruption can be reduced by ensuring FinTech operates efficiently and well prepared for quick recovery. In the event of a disaster, FinTech must be able to recover lost data and transactions from its internal operation, as well as from many dependent tools, systems, and third parties. In the event of data loss, the FinTech must work with its partners to gather the last replication event and recover any data the FinTech is responsible for managing. Business resiliency is strengthened when utilizing cloud-based, highly redundant environments based on multiple data centers, with high availability modes with active/active service deployments. Industry-leading cloud service providers include Amazon Web Services, AWS, Google Cloud Platform, GCP, and Microsoft Azure. 4. Good documentation. Good documentation is necessary to ensure a reliable FinTech program. Like banks' procedures, a FinTech must formalize the workflows and processes that support its business. This includes robust and formally documented policies, procedures, and operations. Sponsors, banks, and other financial institutions regulators will expect the same strong risk management controls to be in place at the bank and any of their FinTech partners. You must have securely designed application and support systems and documented, approved, and implemented programs for risk, compliance, information security, business resiliency, and other processes. 5. Test and retest FinTech systems. Before launch, the sponsor, for example, a bank or other financial institution, and its associated regulatory bodies must ensure adequate testing. All appropriate bodies must sign off on the programs and processes of FinTech before going live. For example, penetration testing and regular vulnerability scans must be performed before launching. This is particularly important as a separate, integrated application, system, and platform to facilitate transactions and trades through FinTech to interface with customer, client, or prospect data gathered by FinTech. 6. Third-party risk management. Third-party risk management must be integrated into FinTech programs. This is necessary because FinTech sponsor banks and other financial institutions often engage contractors who sometimes subcontract works to other parties. Hence, third-party risk management, TPRM, and oversight are a growing area of focus for regulators, banks, and other financial institutions. Building a FinTech solution completely under a firm or institution's control is almost impossible. Hence, third-party risk management, TPRM, is necessary to measure and assess the risks associated with the partners you pick. Some risks are manageable. However, it is unlikely Google Cloud will fail, but a small startup with an engineer has a very different profile. Understanding the potential risks of using a third party will help organizations minimize adverse outcomes, whether strategic, reputational, financial, regulatory, or cybersecurity. Likewise, partners are motivated to proactively manage risk as they face the same detrimental outcomes as the FinTech and the sponsor bank if the risk is not well managed. Active and ongoing oversight of third-party risk by FinTechs is imperative. Besides insight into how the partner performs its services, FinTech must also understand the history of services and any prior issues, all aspects of how the services are delivered, and how data are used throughout the life cycle, created, stored, and transferred. Oversight must also include how the company's data is administered, monitored, restricted, and terminated. Close relationships with partners, including frequent and ongoing communication, will ensure a thorough understanding of the services provided. Know each partner's primary contact points and work to build healthy relationships. Be sure to interact with partners regularly, not just during times of duress or at contract renewal. Risk management challenges for FinTechs. Today's operating environment is dynamic and evolving. FinTech challenges, if not well managed, could impact FinTech's capability to achieve its strategic goals. FinTechs should consider how these issues impact them and how they mitigate their impacts. Several risk management challenges are associated with fintech, including regulatory change, increasing awareness of third-party risk, data governance standards, operational resilience demands, and rising cybersecurity threats. Let us discuss these risk management challenges of fintechs. 1. Regulatory change. Regulatory change is a significant challenge for fintechs, and it is essential to have reasonable regulations for fintechs to protect customers and the financial sector. For example, the UK Financial Conduct Authority, FCA, and Prudential Regulation Authority, PRA, are responsible for the regulation of FinTech activities in the United Kingdom, UK. A good example is digital assets, to which existing financial services compliance obligations are applied appropriately. Fintechs are complex to manage because the pace of regulatory change is accelerating. Regulators are interested in ensuring a good culture in the fintech sector. Good culture in the fintech sector facilitates growth instead of profitability, or their strategic risk management needs to be improved to manage new and emerging risks. For example, the UK Financial Conduct Authority, FCA, and Prudential Regulation Authority, PRA, fund research that explores artificial intelligence, machine learning, and initiatives to protect consumers' rights and ensure financial stability in the UK. Furthermore, the World Bank has created a database of fintech regulations in some countries. Some of these regulations enable fintechs to achieve their business goals. Digital assets are a good example based on the rules and their unique qualities, which can make investments more manageable and safer to grow business and improve operations. Fintech firms can evolve quickly, so their risks and compliance programs must be up to date. They must ensure they have robust processes to actively manage existing regulatory change and compliance risks and regularly scan the horizon for emerging threats in these areas at every stage of their development process. Moreover, fintech firms must be proactive to ensure smooth regulatory change processes and sound compliance governance. 2. Increasing awareness of third-party risk. The United States of America, USA, United Kingdom, UK, and European Union, EU, regulators have expressed their concerns regarding third-party risk. Some fintechs are financial services providers with third-party relationships. While some other fintechs provide software solutions to traditional financial firms, they are third parties and will also have their third parties. Many jurisdictions also enhance their rules to engage with third and fourth parties to minimize third-party risk. A good example is regulators' concern about concentration risk around cloud providers. The European Union, EU, has developed a robust regulatory framework to manage these risks. The financial industry has responded with the GAIA-X project, which aims to implement standard rules that can be applied to existing cloud technologies to ensure transparency, sovereignty, and interoperability across data and services. There will likely be an increase in other jurisdictions to increase third-party regulations over the next few years regarding fintechs. 3. Evolving data governance standards. The traditional financial services industry has understood the importance of data governance. It is implementing data governance frameworks and standards across businesses and organizations. While fintechs may have a business advantage, most were founded with a data-first strategy. Many don't realize that data governance should also apply to their risk management and compliance programs. Increasingly, regulators are asking who owns risk and compliance data to address the following question: 1. How timely is the available data? 2. How well does the available data represent what it should represent? And 3. Is the available data adequate to address core fintech governance questions? Fintechs should be able to answer these questions to affirm the soundness of a fintech program. 4. Increasing operational resilience demands. Financial regulators are improving operational resilience requirements in light of lessons learned during the global pandemic. There are several challenges for fintechs. For example, a traditional financial firm might send its customers to other branches if online services break down, but fintechs might have different options. A firm may have access to a depth of resources outside fintechs during a crisis, including compliance and risk expertise. Some regulators, including the UK Financial Conduct Authority, FCA, require firms to consider vulnerable customers' experience within operational resilience plans. The global pandemic highlighted the need for risk management and compliance programs to be operationally resilient. 5. In ceasing cybersecurity threats. The media and customers are interested in fintechs and their profiles. Likewise, cybercriminals are also interested in fintechs in terms of attacks on their system and operations. For example, Finastra, a fintech firm with $2 billion in revenues, provides some services to financial institutions. It suffered a ransomware attack in March 2020 while moving its employees to remote work at the beginning of the COVID-19 pandemic. FinTech firms spend vast sums to protect their technology and customer data, but how well are they protecting their risk management and compliance data? Spreadsheets, emails, and documents on shared drives are also vulnerable to cyber attacks. The firm's risk and compliance data may be compromised or corrupted, data privacy may be breached, and cybercriminals may access sensitive information. Fintech's risk management weak spots may be exposed. Working with risk and compliance data within a government risk and compliance (GRC) solution can add an extra layer of cybersecurity. Enhancing the risk and compliance capability of fintech. Fintech can respond effectively to new and emerging challenges by establishing a risk framework that enables its operating model. Hence, developing a sound risk and compliance framework is suitable for ensuring transparency, effective cost decisions, and efficiency. Let us discuss 6 steps to developing a sound fintech risk management program. 1. Define roles and responsibilities using a sound corporate governance model. A well-defined risk and compliance governance program helps establish minimum standards and guidelines for committee activities, including developing committee charters, meeting agendas, and templates. Such a consistent construct can support committee design and alignment with the organization's risks and allow for efficient oversight of those risks, for example, establishing and monitoring the organization's risk appetite. A governance model can also empower the organization and committees to determine how much risk the fintech is willing to onboard, as in the case of fraud risk, and at what transaction level and dollar threshold such risk is not sustainable or desirable for the company to do business. Selecting relevant committee members with knowledge of the subject matter can help ensure the committee's integrity. 2. Understand applicable risks and rank the risks. Fintechs are susceptible to several risks like financial institutions, including credit, liquidity, operational, compliance, and reputation. Hence, identifying and scoring the inherent risks associated with the company's fintech activity is necessary. Business managers across the organization can outline the risks related to their unit's activity. An example of a more comprehensive and advanced technique is identifying and mapping critical business processes, noting operational vulnerabilities and regulatory requirements. Furthermore, the nature of a business and its operations will highlight certain specific risks. Risk scoring and ranking promote a more transparent and consistent prioritization process that helps determine risk treatment decisions collaboratively with executive management and helps action and prioritize critical risks. 3. Evaluate the control environment. Having identified and analyzed a firm's risks, it must be evaluated using its risk ranking methodology and framework. The next step is determining what controls are in place to address exposures and identify gaps. A standard method within the financial services industry is to complete a risk and control self-assessment, RCSA, which helps a business determine the current state of its control environment by evaluating existing, formally and informally documented, controls for design and operational effectiveness. The Risk and Control Self-Assessment, RCSA, process can help identify control vulnerabilities and missing controls. It enables a business to determine control measures that should be established, residual risks to be mitigated, and the acceptable overall risk appetite thresholds. Efficiencies can be gained if a common risk taxonomy is developed and used to evaluate and measure controls. 4. Evaluate risk and response options. After risk assessment, risk professionals can review the results for consistency and accuracy of ratings and the scope and coverage of the identified controls based on their understanding of the organization. They can then aggregate the assessments to identify common findings across business units. Once the commonality of issues has been established, the results can be aggregated by theme. Over time, trending analyses can be performed to identify increasing and decreasing risk instances. This can inform trends, emerging risks, testing plans, resource management and deployment. 5. Consider the organization's maturity level and technology use. Risk and compliance maturity can be assessed based on existing, evolving, and mature classifications. An existing designation means the organization meets core risk and compliance requirements and expectations and has a basic operating model with identified roles and responsibilities. Methodologies and processes, although they may be manual, exist to evaluate and remediate any risk challenges. Evolving organizations may utilize a common risk taxonomy to enhance synergies between operations and risk functions, leading to improved efficiencies and rationalized oversight. Process, risk, and control mapping is at a point of maturity where the organization uses this construct to identify vulnerabilities and non-compliance to mitigate them properly and proactively. Large organizations have advanced oversight and execution processes, defined reliance models, and a clear vision and strategy embedded across the organization driven by measurable key risk indicators, KRIs, results. Tools such as the governance, risk, and compliance, GRC, platform enable consistent and repeatable risk management activities, which add to the overall strength of the control environment. 6. Engage management through effective reporting and communication. With the risk and compliance management program up and running, the management team can formalize the metrics by which they measure their risk management practices. Thresholds and tolerance levels must be established and translated into key risk indicators, KRIs, for primary stakeholders, including executive management, the board, shareholders, and regulators. Leading functional units can then balance broad value for the organization and fiduciary responsibility under their respective regulatory obligations. Conclusion. This video has discussed risk management in the financial technology, FinTech, sector, and risk management in FinTech. The FinTech industry, as a technology solutions driven, is growing and evolving. Financial technology, FinTech, institutions provide a wide range of financial services and technology solutions with innovation that creates exciting products for customers using software and modern technology. FinTech companies must ensure that challenges facing their business operations are minimized with risk and compliance capabilities corresponding to their peculiar business operations. The FinTech operations should establish a risk framework that enhances their operating prototype and structure, which would be transparent, efficient, and help in effective decision-making regularly. However, FinTech should adapt quickly to operational disruption in the system and be proactive in applying risk management and compliance. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial, could you give it a thumbs up and share it with your friends? Thank you for seeing the Solomon Fadun, Risk Management of Everything videos. I love to hear from you. Could you post your comments and questions in the comment section below? If you are new here, subscribe to the channel, Solomon Fadun, Risk Management of Everything channel, and press the notification button to be notified when new videos are uploaded. Thank you.